Silver is being described in today's headlines as volatile, overheated, or temporarily distorted by speculative excess. Yet those surface-level explanations fail to address what is actually unfolding beneath the price action. Spot prices across major exchanges continue to display inconsistencies that defy classical arbitrage logic, while physical availability tightens even as paper volumes expand at historically unprecedented rates. Most commentary focuses narrowly on daily price movements or technical indicators, but the real story is structural, rooted in a decades-long framework that shaped silver's valuation far more than supply and demand ever did. By the end of this analysis, it will be clear that what appears to be a sudden collapse is, in fact, the exposure of a system that relied on confidence, leverage, and assumption rather than physical reality, and that the destruction of paper short positions is not an isolated event, but a symptom of a deeper unwind. The critical question is not whether silver prices are moving too fast, but whether the mechanism that controlled them for decades is still functional at all. For more than half a century, the modern silver market has operated under a set of widely accepted assumptions that framed it as liquid, manageable, and self-correcting. Futures exchanges provided price discovery, large institutional participants supplied liquidity, and the overwhelming majority of contracts were settled financially rather than through physical delivery. This structure allowed enormous volumes of paper silver to trade daily without requiring corresponding movements of metal, creating a system that appeared stable precisely because it was rarely tested. As long as participants believed that delivery would never be demanded at scale, leverage could expand without consequence, and price signals could be influenced without triggering physical shortages. The system functioned not because it was robust, but because confidence remained intact. Within this framework, price suppression was not officially acknowledged, yet its mechanics were well understood by those who studied the market closely. Large sell orders entered thin trading hours. Futures volumes routinely exceeded annual mine production by orders of magnitude, and price declines often occurred without corresponding changes in physical demand. These patterns were explained away as hedging, liquidity provision, or algorithmic behavior, reinforcing the narrative that the market remained orderly and rational. Over time, this interpretation hardened into doctrine, and silver's relatively low price was treated as confirmation that the system worked, rather than evidence that it was distorted. That confidence is now eroding, not abruptly but cumulatively, as multiple stress points converge. Physical premiums have expanded even when headline prices appear subdued, delivery times have lengthened, and exchange inventories have declined despite record trading volumes. The divergence between paper liquidity and physical availability has reached levels that are no longer abstract, forcing participants to confront the reality that not all claims can be honored simultaneously. What was once dismissed as theoretical risk is becoming observable pressure, and markets built on rollover and settlement assumptions tend to respond poorly when those assumptions are questioned. History offers numerous examples of systems that appeared stable until the moment they were required to perform under stress. Monetary regimes based on fixed exchange rates, reserve-backed currencies, or leveraged credit structures often persist for years with minimal disruption, precisely because participants internalize the belief that stability is permanent. When confidence begins to waver, authorities typically respond by reinforcing the narrative, adjusting rules at the margins, or injecting liquidity to restore calm. These measures can be effective in the short term, but they rarely address underlying imbalances, instead extending the life of the structure while increasing the scale of its eventual correction. One of the most relevant precedents occurred during the breakdown of the London gold pool in the late 1960s, when coordinated efforts by central banks sought to maintain a fixed gold price despite mounting demand for physical metal. For years, the system appeared successful, absorbing pressure through coordinated sales and reassuring markets that reserves were sufficient. Yet, as demand intensified and confidence in convertibility weakened, the pool faced a simple constraint that no policy adjustment could overcome: finite metal against infinite claims. Once withdrawals accelerated, the mechanism collapsed rapidly, forcing a revaluation that reshaped global monetary arrangements for decades. The parallels to today's silver market are increasingly difficult to ignore. A structure designed to manage price through paper instruments is encountering a phase where physical constraints matter again, and the tools that once suppressed volatility are losing effectiveness. As with past systems dependent on trust and coordination, the early warning signs were visible long before the break became undeniable, yet they were consistently minimized or misinterpreted. The question now is whether the current stresses represent a temporary disruption or the same kind of structural inflection that history has already shown to be irreversible once momentum shifts. The collapse of the London gold pool did not occur because gold suddenly became scarce, but because confidence in the system designed to control its price finally failed. Central banks possessed large reserves, yet those reserves were finite, while claims against them were not. As redemption requests increased, authorities attempted to preserve order through coordination and reassurance, but each intervention merely confirmed that pressure existed. When the pool disbanded in 1968, gold did not gradually adjust to a new equilibrium. It repriced violently, exposing the artificial nature of the prior stability and forcing governments to confront realities they had deferred for years. The lesson was not that price control was impossible, but that it was conditional on confidence. And confidence cannot be legislated indefinitely. Similar dynamics played out during currency crises throughout the late 20th century. Fixed exchange rate regimes in Asia during the 1990s, sovereign debt pegs in Latin America, and even highly sophisticated Western financial structures all shared a common vulnerability. As long as market participants believed that authorities could and would defend the system, pressure remained manageable. Once belief eroded, capital moved faster than policy responses, and mechanisms that appeared resilient were revealed as fragile. In each case, early indicators were present well in advance, yet were dismissed as anomalies rather than warnings, because acknowledging them would have undermined the very confidence the system depended upon. The silver market's modern structure reflects these same principles, albeit through different instruments. Futures contracts, exchange inventories, and cash settlement mechanisms created a perception of abundance that masked underlying constraints. For decades, the volume of silver traded bore little relationship to the amount produced or stored, and this disconnect was accepted as a feature of financial sophistication rather than a risk factor. Price stability reinforced the belief that leverage was harmless and that any imbalances could be corrected through routine market operations. The longer this condition persisted, the more entrenched it became, until questioning it seemed unnecessary or even irrational. What changes in periods of stress is not the existence of leverage or paper claims, but the willingness of participants to accept them in place of the underlying asset. When confidence is high, paper substitutes function smoothly, and settlement conventions are rarely challenged. When confidence declines, preferences shift toward immediacy and tangibility, and mechanisms designed for convenience are tested for credibility. In silver, this shift manifests as backwardation, rising premiums, and delivery demand, signals that indicate a market no longer fully trusts its own abstractions. These signals are often misunderstood precisely because they emerge quietly, before headlines catch up to structural change. The recurring pattern across historical episodes is remarkably consistent. Systems reliant on trust expand leverage during periods of calm, suppress volatility through policy or coordination, and gradually detach from physical or economic constraints. Early stress appears as anomalies, dismissed as temporary or technical. Interventions restore order temporarily but reduce future flexibility, concentrating risk rather than eliminating it. Eventually, a catalyst forces participants to reassess assumptions, and once that reassessment begins, feedback loops accelerate the process. Prices move not because sentiment changes, but because structure fails. Silver now exhibits many of these characteristics simultaneously. Trading volumes have reached levels that are mathematically incompatible with physical settlement. Inventories are drawn down even as activity increases, and price differentials across regions persist longer than efficient markets should allow. Each of these signals alone could be rationalized, but together they form a coherent picture of a system under strain. The recognition of this pattern does not require speculation about motives or conspiracies. It follows directly from observing how systems behave when claims outpace resources. What makes the current moment particularly consequential is that the usual mechanisms for restoring confidence appear increasingly constrained. In past episodes, authorities could expand supply, mobilize reserves, or alter policy frameworks to buy time. In silver, physical supply responds slowly, inventories are limited, and industrial demand has become structurally embedded in modern economies. The ability to overwhelm stress with abundance no longer exists in the same way, raising the probability that adjustment will occur through price rather than policy. This is where the present diverges most sharply from historical analogs. Silver is not merely a monetary metal subject to investment flows, it is an essential industrial input tied to energy, technology, and infrastructure. Demand is no longer discretionary at the margins but systemic, and reducing it would require economic contraction rather than substitution. At the same time, years of underinvestment have constrained new supply, leaving little buffer to absorb shocks. The combination of rigid demand and inelastic supply fundamentally alters how stress propagates through the market. In previous cycles, suppression or stabilization efforts could rely on untapped reserves or future production to reassert control. Today, those buffers are diminished or already committed, and geopolitical fragmentation complicates coordination. When supply chains are politicized and strategic resources prioritized domestically, global markets lose the smoothing mechanisms that once diffused pressure. The result is a system where responses become reactive rather than preventive, and where adjustments occur abruptly once thresholds are crossed. The exposure of long-standing price-rigging allegations therefore arrives at a moment when the system's capacity to absorb shock is unusually limited. What once could be managed quietly now unfolds in full view, because the underlying constraints cannot be deferred. Paper shorts are not being destroyed by sentiment or speculation, but by the collision between contractual promises and physical reality. The critical question moving forward is not whether authorities recognize the problem, but whether recognition alone is sufficient when structural limits have already been reached. What ultimately distinguishes the present silver market from previous periods of stress is the exhaustion of flexibility across every major dimension simultaneously. Supply constraints are not cyclical but structural, the result of decades of capital misallocation driven by artificially suppressed prices that discouraged exploration and mine development. New silver projects require long lead times, extensive permitting, and significant capital, none of which can be accelerated meaningfully in response to short-term price signals. This reality removes one of the most powerful stabilizing forces markets typically rely upon, the ability of higher prices to quickly incentivize new supply, and replaces it with a prolonged lag that magnifies imbalances rather than correcting them. At the same time, demand has become less elastic in ways that did not exist in earlier cycles. Silver's role in modern industrial processes, particularly in energy transition technologies, electronics, and advanced manufacturing, means consumption is increasingly tied to policy mandates and infrastructure investment rather than discretionary spending. Governments pursuing electrification, renewable energy expansion, and digital infrastructure cannot easily substitute away from silver without compromising strategic objectives. This transforms silver from a marginal commodity into a critical input, reducing tolerance for shortages and amplifying the urgency of securing supply at almost any cost. Geopolitical fragmentation further compounds these pressures by undermining the assumption of global fungibility that once underpinned commodity markets. Export controls, strategic stockpiling, and national industrial policies constrain the free movement of metal, creating localized shortages even when aggregate supply appears sufficient on paper. When producing nations prioritize domestic use or limit exports, importing regions are forced into competition, not only with investors but with sovereign policy goals. This dynamic compresses available supply into narrower channels, intensifying stress precisely where paper markets are most exposed. The financial architecture governing silver trading is ill-suited to operate under these conditions. Futures exchanges depend on confidence that delivery demands will remain manageable and that price discovery can occur without destabilizing settlement mechanisms. As physical tightness persists, the cost of maintaining short positions rises, not only through margin requirements but through the growing risk that positions cannot be closed without acquiring metal that is scarce or unavailable. Each incremental increase in delivery demand forces short sellers to reassess exposure, creating reflexive pressure that drives prices higher and liquidity lower. This sets the stage for a near-term window in which multiple pressures converge. Contract expirations, inventory reporting periods, and industrial procurement cycles intersect in ways that concentrate demand for physical silver within specific timeframes. Market participants who once relied on rolling positions forward may find that counterparties are unwilling or unable to accommodate continued deferral, forcing decisions that cannot be postponed. The resulting behavior is less about strategy than necessity, as actors respond to constraints rather than preferences. In this environment, volatility becomes a function of scarcity rather than speculation. Price moves accelerate not because traders chase momentum, but because available supply cannot satisfy competing claims simultaneously. Institutional responses, such as raising margins or altering contract specifications, may reduce visible stress temporarily, but they do not create metal, and they often shift pressure elsewhere in the system. Each intervention narrows the path forward, increasing the likelihood that adjustment occurs abruptly rather than gradually. Stakeholders face diverging incentives that further destabilize coordination. Industrial users seek to secure long-term supply, regardless of price. Investors interpret shortages as confirmation of thesis and reduce willingness to sell. And short sellers face asymmetric risk that escalates rapidly as prices rise. Regulators and exchanges must balance market integrity with continuity, yet their tools are designed for liquidity crises, not physical scarcity. When intent collides with constraint, outcomes are dictated by the latter, and control becomes an illusion rather than a capability. The unresolved tension at the heart of the silver market now centers on timing rather than direction. Structural forces point toward repricing, but the precise moment when accumulated stress overwhelms remaining buffers cannot be forecast with precision. What is clear is that the margin for error has narrowed dramatically, and that even minor catalysts can produce outsized effects. In such conditions, stability is fragile, and the distance between apparent calm and disorder is measured in days rather than years. As pressure intensifies, official commentary and market-facing narratives have increasingly emphasized reassurance, framing recent developments as temporary dislocations, speculative excesses, or technical anomalies that will resolve through normal market functioning. Assertions that inventories remain adequate, that futures markets have always operated with high leverage, or that price spikes will incentivize supply responses rely on assumptions that no longer align with structural conditions. These narratives focus on surface metrics while overlooking the constraints shaping behavior beneath them, particularly the distinction between financial settlement capacity and physical availability. Stability presented through language does not equate to resilience embedded in structure. Another common argument suggests that regulatory tools can restore balance by adjusting margins, modifying contract terms, or encouraging liquidity provision by large participants. While such measures may dampen volatility in the short term, they do not address the underlying issue of competing claims on limited metal. In markets governed by physical scarcity, interventions that restrict participation or alter incentives tend to compress risk rather than eliminate it, creating latent pressure that resurfaces elsewhere. The gap between what the system is designed to manage and what it is now being asked to absorb continues to widen. There is also a tendency to interpret the exposure of price rigging as a discrete scandal, rather than as evidence of a broader structural dependency. For decades, price stability was maintained through mechanisms that assumed confidence would remain intact and delivery would remain marginal. As those assumptions weaken, the focus on culpability risks obscuring the more consequential reality that the framework itself is no longer fit for purpose. Markets can survive misconduct, but they struggle to survive when their foundational premises are invalidated by physical constraints. What this analysis reveals is not a single event, but an ongoing process in which long-suppressed dynamics are reasserting themselves. The destruction of paper shorts is not an endpoint, but a manifestation of a transition from abstraction to reality, where claims must reconcile with resources and leverage with limits. Silver's repricing reflects the unwinding of decades of accumulated distortion, and that unwinding will not conclude neatly or predictably. It will unfold as confidence is renegotiated, contracts are reassessed, and participants adapt to a landscape defined by scarcity rather than assumption. The critical questions now facing observers are neither speculative nor sensational. How does a market built on financial substitution function when physical demand becomes non-negotiable? And how do institutions accustomed to managing perception respond when outcomes are dictated by constraint rather than policy? These questions will shape developments not only in silver but across systems that rely on similar architectures of trust and leverage. For those seeking to understand shifts before they dominate headlines, continued attention to these structural signals will be essential. If you find this kind of forward-looking analysis valuable, consider subscribing for ongoing coverage of developments that tend to become visible only after they have already begun reshaping the financial landscape.